So I was talking about the baseline projection, that is kind of like taking your hands off the steering wheel, because in some ways it's a status quo carry forward projection, and this is the baseline projection that I was showing in the other room that you guys were in. It starts off with the 2021 budget, and you see the zero there because you adopted a balanced budget with no surplus or deficit, and hence a zero. But going forward, it's projecting a $200,000 to $400,000 in annual deficits, assuming no tax increases or fee increases on the revenue side. It assumes your wage increases to continue at the historical rates. And the reason you see this kind of red numbers here is largely because of Pennsylvania tax structure and the nature of spending growth. And I want to pause here and make sure that people aren't alarmed by these red numbers and say, oh my gosh, we have been doing the wrong things. In fact, the growing baseline deficit is pretty common amongst the clients that we work with, because again, that's the nature of revenue and expenditure growth. When your revenue grows at a lower rate than your expenditure, naturally you see a deficit. And in fact, the $200,000 to $400,000 in annual deficit that you see here is relatively small compared to your $18 million budget. So again, the township does need a strategy to eliminate these deficits. There are risks going forward, but I don't want anyone to be sort of alarmed by these deficits, because again, this is fairly common as a diagnostic exercise. So, one common question that we get from audiences is, wait, hold on a second. I just adopted a balanced budget. Why do I have deficits in out years? And I kind of want to spend the next couple of minutes kind of talking about the dynamic here of why we see a projected deficit in the out years. Let me talk about the revenue side of the financial equation first. If you look at the pie chart here at the bottom left, your revenues is really driven by your earned income tax. More than half of your revenues comes from the earned income tax, and you still get some other tax revenues, some fees and fines revenues. But again, the earned income tax is really the heartbeat of your revenue growth. If you look at the bar chart to the right, over the last 5 years, your total revenues grew by 5.9%. And as you can see here, really the entirety of that growth was driven by the EIT growth. Your real estate tax, your other revenues grew some, but really nothing like what your EIT growth, which is, again, the heartbeat of your revenues here. So because the EIT is such an important revenues, I want to spend some time kind of diving deeper into that specific funding source. The township has two EITs. One is the resident EIT, and the other is the non-resident EIT. So let me talk about the resident EIT first. You levy a 1% in earned income tax on your residents, half of which goes to the township, and half of that goes to the school district. And like all Philadelphia suburbs, your residents who work in Philadelphia do not pay EIT to the township because of the tax credit provided by the Sterling Act. So if your resident commutes to Philadelphia for work, they don't pay the township resident EIT, but instead pay Philadelphia a non-resident wage tax. At this point, you may be thinking, and I remember from the last meeting, some of you were asking this question, wait a minute, how does the current work from home environment affect my resident EIT tax base? Does it mean that my revenue is going to change because more people are now working from home? And just like any good question, the answer is it's complex and it depends. Right now, Philadelphia is making a distinction between those who are required to work from home, in which case they no longer pay the EIT to Philadelphia, but instead pay their EIT to you, and those who voluntarily work from home, in which case they're still required to pay the EIT to Philadelphia. Needless to say, this kind of distinction, which is kind of vague a little bit, because it's really hard to track, when someone is voluntarily required working from home or required to work from home. This kind of distinction makes it really hard for us to estimate exactly how the current work from home environment is going to affect your resident EIT tax base. That said, we do think there's some upside here. Moving forward, survey indicates that most employers are talking about a hybrid work environment, just kind of like tonight. hybrid meeting, a hybrid work environment. And with more people required to work from home, we think that there's an upside to your resident EIT. But exactly how much of an upside there is, we just don't know yet. But I think it's good news overall in the sense that you should be seeing some increase as a result of more people working from home or required to working from home. Let me move on to the non-resident EIT here. Upper Providence also levies a 1% non-resident EIT. If you look at the pie chart to the bottom right of the screen or wherever, if you have paper copies of your presentation here, you see that the majority of your non-resident EIT comes from those who live out of the state and from 6 different townships. The reason for that is because these 6 townships listed there, Haverford, Radnor, Lower and Upper Merion, and so on, these 6 townships do not have a residence EIT. So when a Lower Merion resident, for instance, if they work in Upper Providence, but they live in Lower Merion, what happens, because Lower Merion doesn't have a resident EIT, what happens is that the entire 1% EIT goes to you and doesn't go toward Lower Merion. And that's why the majority of your non-resident EIT comes from these 6 townships that don't have any resident EIT and from out-of-state residents.
And then those 6 towns represent about 35% of our EIT?
Your non-resident EIT.
Yeah.
So if I were to break it down, I'm going to move to the next slide to help understand that concept a little bit here. Let's look at 2020 here. The blue section here is your non-resident EIT. So according to the pie chart I just showed here, about half of that, about $2.5 million, that comes from those 6 townships. And the other quarter comes from out of state, and then a quarter comes from somewhere else. So let's look at the numbers now that I've talked about kind of what those EITs are. You know, if you look at your total earned income tax revenue growth, you see that your growth really began to decline even before the pandemic. Let me talk about that trend in details. If I look at the resident EIT first, which is the brown section here, it kind of grew by 3% in 2016, 4% in 2017, 8% in 2018, and then you see the growth dropping to less than 2% in 2019 by only just about $100,000 from 2018 to 2019. And then in 2020, because of the pandemic, your resident EIT actually dropped by about 2.2%. So you see the growth kind of peaking in 2018, and the growth was declining in 2019, and the total resident EIT actually declined in 2020 because of the pandemic. If I look at the non-resident EIT, which is the blue section here, similar trends, not exactly the same, but similar. The growth really peaked in 2017 here. You can see really steep growth, 19% in 2017, 15% in 2018, and then in 2019, the same trend here, where the growth really started to decline and the growth dropped to about 6% in 2019. The good news here is the pandemic actually didn't affect your non-resident EIT very much. It still grew from $4.7 million to $5 million. And as a result, your total EIT last year actually didn't drop at all. It grew by a little bit last year. That's the good news here. But the bad news, again, is that your EIT growth really started to decline, not in 2020, but in 2019. And that's a really noteworthy trend, especially as we're developing our forecast. So let me talk about developing the EIT forecast. Because of all the complex factors I just talked about, we have to account for 3 primary things. One, we have to account for the projected economic growth. That's good news here. Moody's is actually projecting a strong rebound in the growth of wages, and they're projecting at least 4.5% growth in wages in the Philadelphia metropolitan area. And that's good news. And that's in part because of the stimulus provided by the federal government and because of the continued vaccination rollout efforts. So that's good. The second factor that we're accounting, which is also good news, is a work from home model I talked about, because more people will be working from home, and we think that as more people are required to work from home, you should see some increase in your EIT, because those people will no longer be paying Philadelphia the non-resident wage tax, but instead pays you. So that's another positive trend for you. The negative trend here is the slowing growth I just talked about, where really the slowing growth started in 2019 and not in 2020. So accounting for all of these three factors, this is our baseline EIT projection, and we actually work with an internal economist from PFM to develop this EIT projection. And just like any projection is not prediction, you know, your EIT may come in higher or lower than what we project, but this is what we think is a conservative projection of what we think your EIT will be. From 2015 and 18, you had robust growth. Here it shows your total EIT actually growing at 8% on an annual basis from 2015 to 18. In 2019, the growth dropped from 8% to 3.5%. Last year, the growth really dropped because of the pandemic to just 1%. Going forward, accounting for the three factors I just showed on the previous slide, we're projecting about 4% in annual growth going forward because of the strong economic growth rebound, but also because of the declining growth that you have seen in 2019. So that's our EIT projection that we have for the baseline projection. And we think it's important to show you, again, because the EIT represents almost 60% of the total township general fund revenues. Let me pause here to make sure that if there are any questions about the EIT I addressed, otherwise I can move on to other revenues. Okay. I'm happy to address any questions at the end as well. So let me move on to other revenues. Those are kind of less important because they're not as big as the EIT, but still important concepts to understand. The second revenue I want to talk about is the real estate tax. Like I said before, your real estate tax has only been growing by about 1.5, 1.6% each year. Why is that so low? Why is that so much lower than your EIT growth? The reason is because of the Pennsylvania law. In Pennsylvania, your property tax is not based on your market values, but instead based on your assessed value. And this chart really shows you the difference between the two here in Upper Providence. The assessed value really has grown minimally when the market values has really increased. Because your property tax is based on the assessed value, the blue line, that's why it hasn't been growing very much. It was still a great idea for the township to establish that levy because that allowed you to diversify your revenue. But the truth is, it just hasn't been growing as much, and that in part affects your total revenue growth. Let me talk about a third revenue trend here that is noteworthy, and that is one-time revenues. As you know, in 2016, 17, and 18, the township had a number of major developments. And as a result of those major developments, we saw one-time increases in the real estate transfer tax and one-time increases even more apparently in the building permits. The township absolutely did the right thing. You dedicated all these one-time revenues toward one-time capital projects, which is exactly what the best practice tells you to do so. But the downside of that is going forward, unless you have more major developments, these one-time revenues are not likely to come back. And so going forward, you would need to find different or alternative funding sources to fund those capital projects that you previously used these revenues to pay for. So those are the three kind of revenue key concepts I want to talk about here. And if you don't have any questions about these, let me move on to the expenditure side of the financial equation here. Just like any local governments.
Just a sec, Van.
Sure.
Starling has a question.
Quick question.
Sure.
Anybody can answer this, but on the real estate taxes, when a piece of property sells, does that not trigger a reassessment, or it stays assessed the same value? The price is going up.
Right. Yeah. So when a vacant land, when you build a building in it, then there's an increased assessed value, and that is accounted for, and you get additional property tax from it. But if just an existing property that is simply because the market value goes up for that existing property, there's no increase from that property, particularly just because of market value.
Talking about the real estate tax or the transfer?
Real estate tax.
That's why I was asking whether it's a transfer. You're referring to the real estate tax, not
What
the
I'm saying is I bought a house for $300,000. I sell it today for $500,000, and the assessed value was $250. Let's say before it stays at $250 regardless.
Correct.
The market value is going up. Okay.
Yeah.
Correct. You would get one time. You will get one-time transfer of revenues, just like you said, but you don't get a reassessment just because there was a sale.
There's a thing called point of sale reassessment, which I don't think the state allows us to do that.
All right. Just curious. I've lived places that generally other places that. That's amazing.
But doesn't the county every so many years reassess properties? Is it
Every
10?
20 or 30 years.
Oh, it's 20 or 30 years.
Yes, 91
It hasn't been
last time
done
they
since
did it.
1996.
She's mentioned that.
96 was the last.
Hey.
96.
I can beat that. Bucks County hasn't done theirs since the 70s.
So how
They're
how do we
lost.
push them to reassess if we're losing money on this?
Sorry, Leanne, I was looking for money.
I got a supplemental bill.
Why? Did they just assume your value?
I don't know.
Every time a building permit's issued, a copy goes down to the county and they come out and
Because of the building?
look at it. They may not reassess, but they at least look at it. Yeah,
That must have been a large deca.
I don't want to say. Full gun.
And I will say that, you know, when the county quote unquote looks at the property again, there's a potential for wins or loses, right? There are cases where, you know, when they look at it again, they reassess it, they can actually drop the assessment as well. So it really depends. It doesn't necessarily mean that if they reassess, it will increase. But what you were talking about, that the last assessment was in 1996. That's a sore point really for most places, because reassessment, you know, costs a lot of money, and the counties usually, a lot of Pennsylvania counties just don't do a reassessment very often. You know, just, you know, as an interesting point, in other states, actually, there are requirements to reassess every couple of years. In Maryland, I believe they have to reassess every 3 years.
That way in Connecticut, every 2 or 3 years.
Exactly. So this is truly
Sales point anyway, but okay.
early when I say, you know, don't be alarmed by a baseline projection, because part of this is a nature of Pennsylvania law. That in part was what I was referring to, you know, in Pennsylvania, because reassessment just don't happen very often. That's why for a lot of places, the real estate tax just doesn't grow over time, whereas your expenditures just keep on increasing. So in some ways, the township is in a good place in the sense that, you know, the real estate tax is not the majority of your revenues. Imagine if real estate tax was 90% of your revenues, you know, you would really see no growth in your revenues. But because your township, you rely mostly on the EIT, in that way, you're a little more diverse that way, in which way you benefit from that. Anything else before I move on to the expenditure side?
I think, go ahead.
Okay, and we can always look back to if something comes up. Yeah, so let me move on to the expenditure side of the financial equation here. Like most local governments, the majority of your spending is on personnel. So for you, about 2/3 of your spending is on people, on salaries and wages, on health insurance, and on pension, as shown in the pie chart here. If you focus on the bar chart to the right here, your expenditure has been growing by 5.1% annually, and that's driven by your cash compensation, your pension, and your operating expenses. I kind of want to go through each of these bars in detail so that you kind of understand what is driving your expenditure growth. And so let me start off with the cash compensation piece of 3.4%. Really, in the last couple of years, just your cash compensation growth was really driven by salary spending growth and not headcount growth. In fact, if you look at the chart here on this slide, your headcount actually dropped a little bit over the last couple of years. It dropped from 67 in total headcount in 2017 to 64 this year. Even though the drop was minimum, if you kind of look in details in the breakdown, you see that police headcount basically stayed pretty much the same. But your fire headcount increased, right? Because you transitioned to providing the 12-hour daily coverage. So how come your headcount was able to decrease even though you increase your fire complement? Because you dropped the public works and other non-public safety headcount here. So you can see 13 to 10 for other departments, and then 16 to 13 for your public works. So really, even though you increase your number of firefighters, your total headcount actually dropped slightly over the last couple of years. I want to highlight that because right now, this year, about 2/3 of your total headcount is on public safety. And so, you know, sometimes people say, well, why can't government be more efficient, and why can't people just eliminate more line staff to make government more efficient. If you look at this chart, there are really limited opportunities to reduce staffing when 2/3 of your headcount is on public safety and only 10 staff is on for other departments other than public works, police, and fire. So I want to highlight this headcount chart here, in part because of that discussion regarding kind of government efficiency that frequently that we hear from people.
Can I ask you a quick question?
Elaine, yeah.
Compared to other townships our size, is this a good first amount of staff? And a good amount, the way that it's broken out between police, fire, public works, and admin?
Sure, and I'm going to have a two-part answer to your question that is not straightforward. One is we can take a look, and that's kind of our latter phase of the project, is to select things to do some benchmarking. And if that's something you're interested in doing, we can certainly take a look at how you compare to other townships. And we have done that through 5-year plans, looking at kind of similar places and see what their headcount looks like. But it's really important to note that like no two places are the same. So for instance, this is just an example from a previous work that we have done, what place A has a much more public works employees than place B. But that doesn't mean that place A is overstaffed. It just means that they provide different services. In this case, because place A actually does vehicle maintenance in-house and place B does vehicles maintenance contracted out. And so it's really hard to compare apples to apples, and the level of services is very different. But I will say a staffing benchmarking exercise is sometimes useful, not so much to say whether or not you're over or understaffed, but more to find out whether you're getting your money's worth, right? If you have more public works folks than the other place, you should be able to say, that's because I provide X better, or I provide this at a higher level, not because of, I don't know. So that kind of benchmarking exercise you just talked about, we can certainly do. We haven't done it, and it's useful, again, to not to say whether you're over or understaffed, but to say what you're getting out of it.
Yeah, if I could say just a couple things on that. We have people ask us about why we don't pick up leaves, right? So if we picked up leaves, we'd have more public works people. The public works, they wanted in-house mechanics, and I was totally against that because that's another head count. And oftentimes municipalities, correct me if I'm wrong, but they keep the public works guys around for the snowplows because you need people to plow, but we contract out a lot of it, which saves us head count as well. So, and then when we built this building, we cut head count because we did a shared services. So we reduced head count in admins. So that's why one of the reasons this building saved us some head count. So,
Well, that's why we went from 13 to 10 in that gray bar.
so if we want to start collecting leaves, that number will go up, and and other things
Or
like that.
trash.
Or, well,
You mean refuse and
no, I mean just the leaves, like in the fall, because then we need more people.
that feeds into your comp claims and
Oh,
it
that's,
all.
yeah, it's
Right.
And we know fires will be there.
that'll go on.
I know that you contract out trash and recycling services.
No, we don't. It's all a subscription based. It's
Right,
on the homeowner.
right. And frankly, again, we'll take a look and we'll talk to your public works director about it. But off of this conversation, that financially speaking, that's really the best way to do it, because the revenues doesn't come through the township, right? It's kind of all contracted out. You're not assuming any responsibility, and you're letting the homeowners take care of that.
Just so the board knows, Van is meeting with department heads next week, some one-on-ones, so that'll be the next phase. So. Go ahead, Van, sorry.
No, these are great questions. And, on the trash collection piece, I'll offer one other thought here. Some places that do trash in-house, they also have to deal with illegal dumping a lot. If they kind of don't do a good job and pick up trash, then they have to deal with the remaining trash, right? So there are other issues when it comes to doing trash in-house. But all right. Let me move on to the kind of the second primary personnel spending. I talk about cash compensation. Let me move on to the health benefits piece of your personnel cost. If you look at the chart again at the bottom right here, you really see your health benefits spending really being flat over the last couple of years. And I'll have to tell you, when we looked at these trends the first time around, I was saying that, am I looking at the right numbers here? Because health benefit spending usually is not flat. And here I will say, I think the township actually have done a phenomenal job controlling your health benefit spending. What do I mean by that? In 2015 to 16, you kind of see your health benefit spending grow from $2.7 million to $3 million, right? In 2017, it dropped back down to 2.7 million, and that wasn't automatic. That was because you introduced a high deductible health plan to your employees and also introduced a health insurance opt-out program. Those two programs led to your health benefit spending dropping in 2017. Okay, when in most places and nationally, what we see is health premiums typically grow by at least 4% annually. So you were able to control your health benefit spending growth in 2017 by making changes to your health benefits plan. In 2018 and 19, it kind of grew a little bit because you didn't have more plan design changes. And actually in 2020, your health benefit spending was going to increase as well. But you controlled that by maintaining your positions vacant because of COVID. That's why it dropped to $2.6 million in 2020. This is to show kind of, what kind of taking active action does to your health benefit spending growth. And again, to highlight the fact that you have done a really good job in controlling the spending. But moving forward, again, absent corrective actions, absent any changes, there's a risk that, your health benefits will keep on growing. Nationally, again, it's growing by between 4 to 7%. So we expect that to be the case. Again, unless you make changes to your plan designs or unless you have your employee contribute something toward the health benefits plan. But so far, at least from the last couple of years, you guys have done an amazing job in terms of controlling your health benefits spending. Let me move on to the third major personnel expenditure, and that is pension. You have two types of pension plans. One is the defined benefit pension plans, which is the kind of more traditional pension plan where when someone retires, they can expect an X amount of money coming through. That's the kind of more traditional pension plan. You have a second type of pension plan, and that's a defined contribution plan. That's kind of more like a 401k, what you typically see in the private sector. Those are the two plans that you have here. The funding for these plans are different. Let me move on here to the next slide to explain that more in details. This slide shows your total pension contributions from 2007 all the way to 2021. And if you haven't seen this chart before, you're probably saying, wow, the growth is so big and so steep over the last 15 years. Is that true of other places? And the answer is, this is not uncommon for places to see really steep pension contributions over the last 15 years. What is interesting about this chart is you can see that different plans grew at different rates, or rather, different plans have different growth patterns here. So if you look at the gray bar here, this is your non-uniform defined benefit plan. You kind of see it growing from 2007 up and down a little bit, but generally a growth trajectory, and recalculate that the growth is about 10% annually, growing all the way to 2014. And starting in 2015, it really started dropping gradually over the years. On the other hand, if you look at the blue bar, which is a police defined benefit plan, you see it starting actually as a smaller contribution than your non-uniform plan, but over the years it really increased, and by 2021, your police contribution was actually higher than your non-uniformed contribution. Why do these two plans have such different growth patterns? I'm not an actuary, so I can't tell you all the reasons there are, but I can highlight two things here that is noteworthy. The one here is for your non-uniform pension plan, because you eliminated this benefit for your new hires beginning in 2017, new hires in 2017 need to start participating in that 401k plan I just talked about, which is a defined contribution plan. Because you eliminated this benefit for new hires, that's why your gray bar really should start dropping over in the long term, and you can really start seeing that beginning in 2017. And if I extend this chart even further out, you should really see it dropping more and more so, because you have basically closed out this benefit for your new hires. So that's reason number one for why your non-uniform pension plan was able to kind of decline slightly over the last couple of years. The second reason why these two plans have such different growth patterns is because of the different investment return assumption. Your non-uniform pension plan assumes a 7.25% in investment return. Your police plan here, it was assuming 8% from 2007 all the way to 2014. It was assuming 8%. In 2015, you dropped that investment return slightly to 7.5%. But in all the years, your police plan's investment return assumption was still higher than your non-uniform pension plan's investment assumption. Why does it matter? Well, when you assume a certain investment return assumption, let's say 8%, what you're really saying is that I'm going to achieve that investment goal each year. When you fall short of that investment assumption, when you fall short of that 8%, just like you did and everyone else did in 2008 and 2009 in the Great Recession, when you fall short of that assumption, what you have to do is essentially have to pay back those investment losses in subsequent years. So you're really paying back those losses in all of these years based on your actuary calculations. What we think is happening here is that because your police plan's investment assumption is higher than your non-uniform plans, what it was doing is your police plan had to pay more of the investment losses over the years than you had to do with your non-uniform plan.
Right.
I know that was a lot, so let me pause here.
Does it have anything to do with the size of the department?
I'm sorry, can you repeat the question?
Does that have anything to do with the number of police officers we have?
Unless you have increased it significantly, when we looked at the last 5 years, your number of police officers have pretty much stayed the same. It could be if you have increased it significantly before that.
If you go back to the early 2000s, it's different.
You're absolutely right, and that's why I said it's not all the reasons why that is increasing by so much. But this is what I'm explaining here. The investment assumptions is one of the few reasons. Again, I can't tell you exactly all the reasons. Another reason you just mentioned headcount is one reason. The other reason I haven't talked about is mortality differences. You assume a mortality rate in your pension plans. If your mortality differs significantly from your assumption, that will also impact your pension contributions. Again, because of all the complex factors that goes into the calculation, that's why you need an actuary, right, to calculate all of these different factors. But you're right, headcount can make a difference as well. The reason I wanted to talk about investment assumption so much, again, knowing that it's not the only reason that drives these growth, is because we think there's an upcoming opportunity here. Next year, in 2022, your actuary is projecting that your pension contribution to actually drop next year. When we asked them, why is that the case? Your police actuary said that it was because of the strong investment returns experience in 2019 and 2020. The numbers he gave us actually showed double-digit investment returns in the last 2 years. And that's why your police actuary is projecting a drop in your pension contribution. We think it's an opportunity here in the sense that this may be a chance for you to update your investment assumptions. Again, like I said, the police plan has a higher investment return assumption than your non-uniform plan. So you might want to think about kind of updating that so that it's more reflective of your actual investment experience. Doing that will cost you money. Doing that, your actuary estimates that if you reduce and update your investment assumption, it's going to cost you $882,000 more over the next 5 years, not annually, but over the next 5 years. But if you don't make the change, there is still a risk that your funding levels will drop, and which will still drive your payments higher, holding everything else constant. So it's just a matter of whether you want to make the change proactively now or kind of deal with the increases in payments later on. So I want to highlight this investment assumption so much because we think there's an opportunity coming up given that there's a projected drop in your MMO projection.
Yeah, just so you know, we're joined here also on the agenda tonight. We're getting a quarterly pension report. So our pension advisors are actually in the room with us, so it's kind of timely. So
Perfect. And let me just say the updating the investment assumption, that was also a recommendation by your actuary too. We work closely with him to develop. This is all provided by your actuary, and that was his recommendation as well. So just want to be clear about that. So again, something to think about. We will certainly talk about this concept more later in our 5-year plan process, especially as we talk about different recommendations and how all these different recommendations should all tie together to be reflected in your 5-year projection. The last trend I want to talk about is your capital spending trends. Here, if you look at this pie chart here, what we're showing is that the township actually has been using a really balanced approach to fund your capital needs. Again, this is another thing that we found to be positive in evaluating your financial condition. About half of your capital needs in the last couple of years were funded by debt, and the other half was funded by pay-as-you-go, which is simply a term to say you use your general fund resources. So the other half was built off of the pay-as-you-go and some state and other revenue sources. When I say the township has been using a balanced approach to fund your capital needs, what do I mean by that? Ideally, you should match your kind of larger projects, your assets with longer useful life, just like a police station. You want to use debt-funded resources to pay for those large projects that have a longer useful life, because debt is typically paid down over at least 15 years. You want to also match your assets with shorter useful life, like your vehicles, like your roads, with pay-as-you-go money, because those have a shorter useful life, and that should be paid out of your general fund resources. What we have found is basically we have done what the best practices said. You should match your assets with longer useful life with debt-funded finances, and you should match your assets with shorter useful life with pay-as-you-go funding. So again, this is just to kind of validate the things that you have been doing in the last couple of years, and validate that using debt-financed money to pay for your police station and your municipal campus update was the right thing to do. Of course, the downside of doing the right thing is that it costs money. When you use pay-as-you-go money to pay for your vehicle upgrades, to pay for your technology, to pay for your roads, to pay for your stormwater, all of that takes money. And when we said that earlier, when we said your baseline projection shows $200,000 to $400,000 in annual deficit each year, that projection includes all of the capital needs that you have identified in your 2021 capital plan. And those are not small amounts of money. Aggregating everything, it shows about $3.2 million in annual capital pay-as-you-go spending each year that is baked into the baseline. It doesn't include anything above and beyond, so it doesn't include any additional debt issuances or anything like that, but it does include anything that you have already identified through the 2021 budget process. So let me try to sum it up and bring us back up to the bigger picture level in terms of what that means for you. Again, we think that Upper Providence is at an inflection point right now. We talked about the earned income tax of having really robust growth in the last couple of years, averaging 6.1% in annual growth. But moving forward, right, because we have already seen a decline in your growth rate, and there continues to be some uncertainty in terms of the pandemic, we think the growth is not going to be as high going forward as you saw in the last 5 years for your earned income tax. We talked about the real estate tax, how establishing the real estate tax was the right decision and a good decision for the township because it brought you new revenues, but that revenue really only grows by 1% to 2% annually, right? We talked about how you've been able to keep your health insurance spending growth really flat and much lower than the national trends of the last 5 years. But going forward, unless you make further plan design changes or unless you have your employee contribute something toward the health premiums, you're going to see your health benefits growing at some rate, between 4% to 7%, depending on what healthcare inflation is going to be. So again, a lot of strength that we see from the last couple of years, but some risk going forward. And that's why we say, again, that Upper Providence, we think, is at an inflection point here. And frankly, that's why you're doing this 5-year plan. You're doing this 5-year plan because you know that there are strengths and you know there are risks, and you want us to help you to develop a recommendation so that you manage these risks, so that you eliminate the deficits that we talked about. But also, probably more importantly, so that you can create some room in your budget so that you can make the investments that you want to make. I assume that you don't want to kind of just go status quo from here. You want to make investment into your residents and to your businesses, and that's why we're here to make sure that you're able to not only just react to your deficits, but more proactively manage it and create the room that you need to create to invest in your residents and businesses. So that's kind of what I have for today. Like I said before, there are a couple of things coming up. You know, we have completed our initial financial condition assessment, but we're talking to your department heads starting next week. We're talking to your police chief, we're talking to your public works director, and so on and forth. I think we scheduled like 6 interviews next week, so that we talk to your department managers and understand how they do what they do. You know, we can't provide recommendations in a numbers vacuum. That's not what we do. And so we got to incorporate kind of the human aspect of things into this analysis, and that's what we're doing next. We also know that you're getting $2.4 million from the American Rescue Plan Act. And there's a question, I believe most companies have this question, of like, how should I spend it, right? Where should I put it so that I get the most return on investments? And so I'm not just spending on somewhere and then I run out of the money, and then 2024 comes, I run out of all federal funds. We want to help you figure that out. We want to bake that analysis into this 5-year plan so that at the end of the day, again, later this summer, we are hoping to be able to provide you with some sort of prioritized strategies that not only address the deficits that we talked about, but also give you the room you want to make investments in infrastructure, and also give you a strategy as to how to spend that $2.4 million so that you get a higher return on investments. Let me pause here and see if anyone wants to ask more questions and discuss anything that you want us to look into going forward.
And I had one question on that ARP money. You know, the Treasury guidelines just came out, which provides guidance on how we spend that money. I think one of that can be used for replenishing our general fund based on lost revenue.
Yep.
Have you done an analysis on that? Richard and I both think that's easier to just do a one lump sum replenishment of our revenues rather than trying to put it towards certain projects. I didn't know if you've dived down enough into the numbers to give.
Yeah, so we did do a preliminary review of your numbers, and we think at this point that you should be able to, let me backtrack a little bit because I've been in the ARP conversation for so long, and I assume everyone understands it. The Treasury guidance says that you can use the money toward revenue loss replacement, and then everyone is really focused on that, to use the money for revenue loss replacement. The reason everyone is focused on that is because the revenue loss replacement category has the most flexibility in terms of what you can use it toward. The Treasury guidance basically says, if you find yourself being able to use revenue loss replacement, you can actually use it toward provision of government services. And this is quote, provision of government services. Essentially, it has a lot of flexibility. You can use it to pave roads. You can use it to maintain your buildings. You can use it for anything, really. And so that's why everyone is focused on the revenue loss replacement dollars that they're able to dedicate toward. Our preliminary calculation is that you should be able to use $2.4 million, the entire thing, toward revenue loss replacement. You're not going to get all of that money this year. You're going to get it this year, but you can't use it all this year. And we're going to give you a schedule of what we think it would be on a year-by-year basis. But our analysis is that you should be able to use the full $2.4 million toward capital projects or whatever that you think is worthy of investing in, as long as it falls under the provision of government services.
Thank you.
I'm gonna jump back a little bit too. And here we talked about in this projected budget, you had 1.5 million in pay-as-you-go capital spending and another 0.9 million, and that's debt service on the bond we just floated, right?
Yeah.
The 1.5 million, that covers paving roads. What else was in the 2021 budget under that number? I mean, I just want to understand the things that are in that 1.5.
Yeah. Tim, I know that there are some stormwater projects. I know that
It's all road. I think probably what, Richard, $1 million is probably road pavement. We've had some stormwater management projects and Ashenfelter Bridge.
Caroline and Carmen.
Thank you, Brian. Thank you.
Yes, thank you, Brian. That's what I wanted to know. What was, okay, good. All right.
You can go back to your last slide, unless anybody else says it. I think you were on the third bullet.
Oh, I'm sorry. Yes. Yeah. So what we will do here is we'll come back. We'll talk to the department managers next week. We'll kind of go back to our drawing board and say, okay, what did we learn from this baseline financial condition assessment, and what did we learn from talking with the departments? We'll go back to the drawing board and start really developing recommendations. And the next time we come back in front of you later this summer, we'll give you some draft recommendations, and those will be in line with the best practices and kind of our experience working with other municipalities elsewhere, and say, does this look right to you? Does it make sense? These are what the number shows, and what we believe if you do all these things, you should be able to A, eliminate your deficits, and B, create X million dollars for your investment needs. Is that enough? What are you thinking in terms of what you want to do? How do we make sure that you address your service demands in a fiscally responsible way is kind of what we're trying to get at through this plan. Again, I think the next time we come back to you will be later this August, in August, when we will have the draft recommendations ready to present to you.
Then, could you reiterate what was the last stage? It might have been this first slide. So the next one is your draft recommendations. That'll be the end of August. And then development and plan delivery. Is it?
So today is the financial condition assessment. That's number one here. This is next week. We're going to talk to the department directors next week. And then the last thing is to develop recommendations and really to show you what those recommendations are and get your feedback. That will probably be in August, is my guess right now, in terms of how the process would go. And as I mentioned to Tim earlier, our goal is really to get this 5-year plan done by the end of August, if we can, so that you have everything you need as you enter the 2022 budget process. Because I believe you enter the 2022 budget process in the fall, sometime in September, October. And so we want you to have the plan in your hand.
Gotta get started earlier
Before you enter the 2022 budget.
That was really informative. Thank you
Yeah.
Of course.
so much. I don't know if anybody else has questions, but that was really.
Dan, if you want to stay online, our pension advisors, they're going to give us a quarterly report because you had some good segues in there. So
Great, I'll be happy to. And everyone, we're sorry that we're not able to come in person. I have an infant who is 4 months old, and but we hope to be able to come and present to you in person when we deliver those draft recommendations in August. So hopefully this worked out okay.
I'm going to try to, Brian, are we, so the other PowerPoint, she's sharing her screen. So
If you
I can stop sharing.
show the
do you want to stop sharing? Yeah, stop sharing. And then where are we here? Go back on the PowerPoint, right?
Yep.
Oh, sign it.
Just say hi now.
Not really required, I guess. John, it's not on. Pension updates. There you go. I have those 4 slides. So.
Okay, good. It's nice to meet with everybody in person. It feels normal. I'm Jeff Hugo. This is Rich Ritzer. We've been fortunate to be working with the township since September of 2016. So our charge was really, when we got involved, was understanding what the assumed interest rate was for the plan, and then building an allocation strategy to hit that. we'll hopefully exceed that so we can pay off some prior debt service. In that time frame, we've been able to, our compounded return on the police pension plan was 11.5%. So what that means to the township is you assumed you're going to get 7.5. The fund performed 11.5, so you beat those assumptions, which means it lowers your ultimate cost going forward, which is a very good thing. And so that's in the packet that I gave you tonight, we gave you the returns through the end of the quarter, which we thought would be helpful. I think they were distributed. But what we've done in the interim, since we're almost into the next quarter, I ran the report as of Friday, just because the numbers of it are so good. And that, so what I'd like to do is, in the packet that I just provided, we'll walk through the police pension plan. And in that course of this conversation, maybe we'll delve into some of the issues that Deanne brought up, and we'll try to explain those. One of our goals is to try to take actuarial language and turn it into English. And that's kind of what we would try to do, because, but let's just take a look, if we can, at the police pension plan in the packet on the right-hand side. The fire plan and the non-uniform plan are all managed in the same manner. So numbers are going to be very similar. As you look through them, they may be off a little bit, and that's basically a function of cash flows. So that in the police pension plan, I'm going to ask you to please turn to, just for speed purposes, page 13. Because page 13 is a summary, and we'll go from that, we'll back into where those numbers were derived. I'm sorry, I don't know.
That's okay.
But you can have my one.
I don't need it.
Okay.
That's the last on this plan.
So on the police pension plan year to date, the numbers are up 8.57%. So again, you're assuming 7.25 on an ongoing basis. We're ahead of that assumption year to date because of the strong market performance. Last year, as Leanne said, we were actually last year the performance was up 15.16% for the police plan, and the year before that it was over 21.5. So just a good time. It's a good time to be in markets. I give kudos to you folks here because you didn't panic when the market. I mean, a year ago it was scary times, and a lot of people could have said, "We don't want the risk." We had one client that actually told us to cut back. They couldn't take the heat. And to your credit, you stayed the course, and you were able to. In that, when opportunities like that arise, and I use the word opportunities very loosely, but when we see things like that happen, we go through and rebalance our portfolio. So we will buy stocks when they're on sale. So in the course of 2020, we rebalanced 5 times, Rich. So we sell the things that are higher and buy lower. And that process helps to enhance the returns. And we also make some strategic changes in the portfolio where we added, when we saw the portfolio or the market coming out of the recession, we made a strong position in high yield bonds because that's the first investment class that comes out of a recession. And we got double-digit returns in the fixed income area in bonds, which is kind of unheard of. Suffice to say, that's how we got to the numbers we got to.
I have a couple of questions.
Shoot.
So I don't remember making that decision on this thing here.
You didn't. You didn't.
Who made that decision for us?
We're discretionary investment managers, so we make those decisions. We stayed invested. We stayed, unless you override our discretion and tell us to do things, we
Okay,
continue
so-
to manage your funds.
Okay, so you guys decided on that was a good thing to stay into that. I'm not arguing. the
No, 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 no.
point, because
But we had clients that overrode.
When you said you guys stayed the course, I'm thinking, I don't remember telling you guys to stay the course.
We managed to, it would look like
So
this.
I thank you for doing it.
Yeah, okay. Well, that's what you hired us.
Yeah, absolutely.
Okay, so we take discretion, we make those changes we see appropriate. Again, our goal is to hit that 7.5% assumed interest rate with a proper amount of risk. So
Thank you.
we found that when we first got involved with the township, we came to consensus that the most amount of risk we wanted to take was 70% in equities. You get more than that, you have an opportunity for more return, but the volatility gets much more severe. So that's the top line constraint on the volatility we were able to stomach on the township, and you were rewarded for that, because prior to that, you had a much more balanced, I'm gonna say closely 50-50 probably between stocks and bonds. So we convinced the township folks at the time that we need to be more aggressive to hit that 7.5% assumed interest rate. You agreed with our decision and we were rewarded for it.
I have a quick question on that, and that goes back to, was brought up in the previous presentation. So we exceeded the 7.5. Does the extra that we've made sit in that police fund and offset?
Well, then when Joe Duda, your actuary, does evaluations, he will then give you a number which is called the minimum municipal obligation. We hear the term MMO thrown around, but it's the least amount of money you need to put in the pension plan to be compliant.
That comes out every September, right? September
Right,
30th.
And then
So-
once we meet that,
Right, and so that's derived from your investment returns, your mortality assumptions, your salary assumptions, the number of folks you have in a plan, and those are the key components to that plan. One thing that DN did not mention in police pension plans, which is the cost of benefits can vary, and it varies mostly because of disability. I don't know if you've had any police disabilities, hopefully not.
Just cursed us.
Yeah, because the assumption they're saying is, I'm hiring an officer at 25, he's going to work to 50, at 25 years. And along that line, he's gonna get a certain amount of raises in his pension plan. And if all those assumptions come true, it's easy to fund the plan, right? The problem is, those assumptions don't come true. Sometimes we have a situation where a 28-year-old officer has a disability, you start paying his pension 20 years earlier than you wanted to. So you didn't put the money in, he's taking money out. So those are the types of cost of benefits functions that can really whack the funding of a plan like you have here. So one of the other key decisions that she also mentioned that you did was the law allows you to not continue to use that type of pension benefit for new hires for non-uniform folks. So you made that decision to, on the non-uniform side, set up a defined contribution plan where you're giving them % of pay, and that employee then takes that risk. They take the investment risk, they take the longevity risk, they take the earnings risk, like we do with Rich and I, where we're to see this. We have a 401k plan, we take all those risks, and we have to fund it ourselves, and they give us a little bit of a match. You're much more generous than that.
Yes.
Yeah, and state law does not.
State law says if you have a police officer has to have a defined benefit pension plan, so you can't make that change for them, but you can for the non-uniform plans, which you did. So that's why you saw that cost line.
And fire.
even out.
Fire.
In fire, that's right, in the fire. It's the police officers under Act 600. That specifically state you have to get in a pension plan. So given that, last year, I think I saw from the slide, your MMO was about $850,000. Because of the good returns on the pension plan, Joe Duda ran the MMO projections going forward, and the MMO is determined by 2 years of returns. Fortunately, it was this year and last year. But the last 2 cycles, there was a good year and a bad year. There was a good year and a bad year, a good year and a bad year. So you never really showed your return that you needed to make. So your MMO kind of creeped up. Here we had 2 great years in a row. So your MMO that Joe calculated is going down about $300,000 from $850 to $550. So as Van said, okay, so you can either capture that savings and use that in other parts of your budget and continue on as you have going forward, or you can lower your assumed interest rate, because our projections are on a forward-going basis. It's going to be extremely harder to hit that bogey. We think that a 70% equity position, 30% fixed income like we are now, over the next 20 years, you're more likely to get somewhere in the neighborhood of 6%. Okay, so we're assuming 7.25 or 7.5. So by definition, if we're assuming 7.25 or 7.5, and we expect to earn 6, that's going to rise. Now, fortunately, in the last short term, we've been up, way over that, and year to date, we're over that. So
Generally over a long period of time.
over a long
7.5
period
is
of time,
pretty high.
that's right. It's very high, but that's a decision you have to make collectively. Okay, you can capture that and lower your MMO by that $300,000 this year for the next 2 years, really, because the MMO is based on the next 2 years. Understanding that it's likely that we will not continue to hit 7.5% on an ongoing basis over the long run.
Would you change the mix knowing that
We could, but again, we're constrained by the amount of volatility. Because if we go to 80% equities, which would get us closer to that number, but in a bad year, it's gonna be bad, right? So,
It may not be as prudent. to
so
take on that much.
we think that just the trade-off, in dealing with about 100 different municipal folks like yourselves as clients, we think that 70% is kind of a threshold on the amount of exposure we should have in the side.
Al, do you mind, I find this to be a fascinating chart, if you could share.
Oh,
that
sure.
with us.
So and this is interesting because JP Morgan does this analysis every quarter. And what it says is that on average, you should expect about a 14% decline in the stock market in any year. That's just, and you see it's reflected in year by year, but on average, again, 31 out of 41 years, the stock market has turned positive. It goes back to what you said before. You held the course, you didn't panic when they were down like this and locking your losses. Because if you let it, best example was really last year, it was down 34% at one point in time, but ended the year up 16. So in a long-term liability situation like a pension plan, it's prudent to invest in the long-term, have a equity exposure like we have here, 70%, and then let the market work. And then how we add value is to manage it, make changes when we see rebalance to make sure that if like the best performing asset class in 2020 was large caps, growth stocks, Facebook, Amazon, all those because of the COVID situation. So at the end of the year, we sold off a position on that and bought the less popular value stocks. Well, guess what? The value stocks are up 19% this year and growth stocks are up 7%. So we sell high and buy low on a periodic basis on your behalf. And that's where we're able to generate the types of returns that we do. So, what Joe did is said, okay, look, if the township has these types of choices, they can stay at the current assumed interest rate, they can capture that savings, or if you take just a piece of that savings and lower your assumed interest rate from 7.5 to 7.25, your MMO will go, and I'm giving for a sheet that he said.
It's their job to interpret the
We're
actuary.
by 8. So instead of 550, it'll be 6.25. So you could capture, you could go to 7.25 and still lower your MMO cost by about $250,000.
So that's a choice we have to make.
That's a choice you can make. That's a choice he's suggesting. You can continue as you are now and capture that full savings, or you can go for the long term and be more prudent about what you can expect to receive.
I think we should be prudent.
And that's so do we, but we'd like you to make sure you have
That's
an
really
informed decision. You look at
It's fun, glad we're
Well,
having this discussion.
I was never for that because I was never for lowering it because it just we're killing our budget for really no reason. My point is, there's a reason now because we did so well, so we got a benefit. But 2 years ago, we really wouldn't have gotten much of a benefit, and it would have cost us a lot more money to do it. And I would have pushed that down the road. But I'm okay, and I'm for doing this reduction.
And also because the returns were so good, you had some we call past service liabilities, but because we didn't do well in the past, you kind of got in the hole a little bit. Well, we dug out of the hole. So if you kept that 7.25, that hole's down to $35,000. So the pension plan is almost fully funded. Right? So on an ongoing basis, as the officers work for this year, they're going to give you accrual benefit for this year. But you may not want to pay down that total amount of deficit you were in. So if you go to 7.25.
That's green.
So the MMO, yeah.
I'm gonna pick up some milk on
So
your.
you can lower that to, if you went to 7.25, that deficit you have in the past would be 82,000, which on a $15 million pension plan is basically nothing. And again, he showed the numbers on 7%, even more so. But he shared that with Rich. I mean, this is the information.
99.75% funded, something like that.
Yeah, so The good news is, pension plan is basically fully funded. On an ongoing basis, we think we're gonna get somewhere in that 6.25 going forward, but we did almost 9% year to date, so.
And we don't do this MMO until September, so we have time to discuss.
That's correct. And that memo will be used for the next 2 years. And then the next cycle will be the returns we get this year and the returns we get next year. And hopefully that'll be, you add the two together and divide by 2, right? So it was 22 and 14, so you did 11.5 or 12%. You probably get 7.5, that's where you got the big gain raise.
But there's a catch to all this, is when we go to pension negotiations with the police, the first thing they're gonna say is our pension's almost fully funded, why are we paying
So it's
this?
back to zero.
So that's the battle we're gonna have.
Yeah.
On the other.
That's
exactly
Well,
what
what
it
are they
is,
gonna
right?
say? They're gonna say, why are we putting so much in?
Yes.
It's fully funded.
Right. And in reality, they're putting pennies in comparatively
So
to.
the
I
benefits
think
are
we can change that, but I guess there's no way that would be a complete battle to say you should be in the real world like everybody else.
state law.
Well,
Change the law.
Well, we're only comparing police to police, right? So it's good that we're not fully, so I'm okay with dropping it, but maybe not someone, we don't want to make it fully funded.
Because
They
that would
will
be
throw that
another
right back.
Now, I'll throw one other caveat. If you get overfunded, then you'll no longer get state aid.
See?
Yeah,
Have
yeah,
that-
yeah, gotta be more.
It's not the real world, it's raising their hand to join the real world.
Yeah, like, who doesn't-
Right.
But I
No,
see
sir.
that you're, so you mostly are in the Vanguard index.
We do. So the approach we take is we build the asset allocation models, it's assumed interest rate. But then when we populate the asset classes we want, we use the Vanguard index funds, the exchange traded funds, because they're very, very inexpensive. The information on those is in the packet, but on average, the cost is less than 0.1%. So it's really, they're very inexpensive and they give you full exposure. We found that over time, this type of approach beats active managers because active managers demand a higher price and they take bets and more time than not they don't win.
And we've been able to beat the market benchmark, not because we've been picking the right stocks, it's because like Jeff alluded to earlier about the rebalancing strategies, right? So COVID last year, when we rebalanced, guess what? We got to buy stocks at a 35% discount. And the market came.
Fire
right back.
sale.
Exactly right, right? So yeah, little moves like that actually helps.
But they all compound on top of each other. So it's those little incremental tweaks that we make allow us to deliver the returns we show you here in this pattern. But those are good decisions. I mean, we've been doing this for a long time. We've been many years where MMOs have risen and it was.
Those are the years you don't come to visit.
You always come to visit.
We'll phone it. We'll phone it. I do notice though that when we're doing well, I get my quarterly statements. Quarterly. All right, very good.
But we can, we can talk about this as deep as you want. I don't.
I had one question. I asked
Sure.
Rich last week, this whole looming inflation drama over the next.
So
I know stock markets don't like
it's
inflation.
interesting because it depends on who you talk to. Our corporate position is that there's some dislocations in the supply chain and the like. And because of that, there's some current inflation going forward, right? We just to make things a little settle. The expectation is that will settle. You may see some inflation in 2021, which should be kind of offset by all this excess government spending. We think it's going to level back down to a more normal 2%. But you can see 3% inflation this year, quite. But you're also going to see GDP growth of 7 or 8%.
Also not helpful in negotiations. Inflation is also not helpful in negotiations.
But you should anticipate some inflation.
Yeah.
We think that it's transient and that in the long term, that it will not be, and it's reflected in the bond market. I mean, the 10-year bond market, you can still, it's 1.7,
Yeah,
1.6.
it's not, hyperinflation is not priced in, so.
I'd love to tell the story when I first got married in '82, we bought our first house and our mortgage rate was 16 3/4 on a 3-year adjustable. So we know, we live through inflation. It's just-
So the police pension's based on inflation. So every year it resets. The higher the inflation, the more they get paid on the back end. So it's just. there's
They're always
always-
gonna win.
I like when inflation goes up, pension goes down, but that's, you know.
Kind of crazy to have it guaranteed.
Yeah.
That's rude, what?
Well, but again, if you go back in the 40s and 50s, that was normal.
Yeah.
Corporate America had pension
Yeah,
plans. They were
America's
just-
true.
They were just quicker to react
And
and
more agile, they were allowed to.
Well,
State
if you
laws.
recall, in the 90s, pension plans were so overfunded that people like Saul Steinberg were buying in companies, terminating the pension plan, taking the excess assets and paying off the debt he used to buy the company. He did a Reliance
Crazy,
Insurance.
right?
company. Raiders, but they raided it with their own money because the market was so good in the 90s that it overfunded these pension plans. Hopefully we'll get another run like this where pension plans will be fully funded again and then, and we're close to that. I mean, 5 years ago, most of our clients were distressed, and the pension plans were not doing well. These last 3 years, I made them such that, like yours, it's almost, for the proper funding.
Here's a question, it's probably illegal.
No.
But when you make them a lot of money, is there any way to pull it aside out of it, so you don't fully fund it, have it as a rainy day?
Well, quick answer, you could do that. But what happens then? So you put it aside, you're gonna put it in cash and earn zero. So the next year, we're gonna zero, and your MMO is gonna go from 800 to 500 to,
Just the year that we're negotiating.
well,
Just
okay.
playing.
This isn't
Well,
recorded.
let me suggest this, then. If that's something you want to consider, if you drop your assumed interest rate to 7%, then your past service liability goes, it becomes much bigger, almost $1 million. And you're
Play it
getting-
any way you want it.
I think we
Yeah.
need to know all that. We
Yeah,
need to
right,
know
like-
those numbers.
Yeah.
7.25, and do this cut that.
Well, Rich has,
Yeah, and then that's worth thinking about.
because that gets you more closer to reality. It also gives you that additional benefit when you negotiate, so we're still $1 million in the hole.
Yeah.
Which, if you assume it's 6%, you're $2 million. You can, it's how you play the
So
numbers.
you're pulling different numbers.
You're pulling different levers, but suffice it to say, the pen's in great shape. Okay, so you should be commended for Tim and the staff and you folks for doing a great job and funding it properly and keeping your cops, off disability and all those types of nice things.
You guys did a good job, even just listening to the report prior. Townships been managed well. Okay. Thank you.
And if you read through these information and you have questions, our cards are here. We'll be glad to answer them in detail. I know just in the.
Yeah, between Van's report and this, you'll have a lot of reading.
Can't sleep later.
And how much of it will I understand? Zero.
But that's our job. Our job is to help you understand. So we really want to do that. We take the complex and try to make it understandable. That's
You
really
put an
what it is.
article in there about Pacers. Is the state, I know.
So we did
One of
that
the
only
state's
because,
budget woes is.
so
related.
the state teachers plan purported, the highest paid guy in the state, absent coach from Penn State football team, is the guy who runs the Pacers pension plan. He makes $500,000 a year. And they try to justify that kind of salary by being very creative and buying hedge funds and private equity deals and everything else. And we kick their butt every year just by using passive electorals from Vanguard. It's the public knowledge, so we show it. But they got in a jam because there's a provision in the state teachers plan that says if we don't earn a bogey, and I think the number was like 6 3/4, then we got to go back to the teachers, ask them for money in the plan. And they were like 6.69, they were just below it. So they fudged the numbers. And they got shot, and they got caught. So, and there's an article in the paper that I pulled from the Inquirer just saying that. And one of the trustees said, we should have run the index funds. They were. So you did that, you made the decision in 2016, you've been rewarded for it.
The simpler the better, doesn't have to be all magic.
But people in our business try to make a name for themselves by making it complex and try to, and it's, like you said, simple, it really is better.
Smoke and mirrors.
It really is.
Van card is very low expense funds.
Oh, extremely low.
So,
Yes.
we used to be an ICMA, RC, and you got,
That's why we made a change. That's why I made the change. And we took that just for your own benefit. We made that same type of a change with the employees and their when they invest their own money in that 401A plan, or if they have additional money to 457, we're using those same low-cost Vanguard funds
So you do the police and the non-uniform?
in the fire.
Yes.
We
Fire.
actually have,
How about the personnel here? Or you're just on your own, you're in your own.
I have my own.
Yeah, we also do the defined contribution plans, which are similar to the 401k type of structure. When you guys terminated the non-uniform pension and went to that approach, we also manage those.
Okay.
So we take the same approach here and implement it in those types of plans. So think of it as if each employee, how your pension plan has a 7.5 assumed interest rate. Think of it as if each employee has their own assumed interest rate. Right, because everybody's got their own situation in terms of their
Just like you
retirement.
would in any company.
Exactly.
You're kind of individual, how they want to.
So you have like a little 401K plan here in addition to that, where people can put in their own money on top of it, which is called 457, it's the same idea. And we manage that as well. And Rich meets with your folks. And we actually sit down and do these same type of calculations to show them if we earn 7%, and if you decide to retire at 65, and all those different things. If
You just got social security. that
if you're
kind of
gonna live
stuff.
30 years, here's what you can have as income from this plan. So it's kind of morphed from our doing this for 25 years with municipal pension plans. The people that take advantage of it, they find it to be pretty attractive.
Oh, yeah, I started my career there, yeah.
Oh, did you?
Good company.
Yeah, it is good company.
Like a college campus over
Oh my gosh. We're on.
Who gets that EIT? Is
What's
that
that?
Malvern? Who gets that EIT?
there. Yeah, I know.
So here's a good, so I'll finish with one story, you bring that up. So the borough of Malvern used Vanguard to manage their fund. And they went to an RFP and we competed against them and beat them. We beat Vanguard using Vanguard's funds. Because the Vanguard employees were using their actively managed funds and the index funds, because they're more expensive and they didn't do as well. We beat them hands down. So we managed the Malvern Borough pension plan. We took it away from Vanguard, but we still use the Vanguard fund.
That's what
Do you
Vanguard
think
is.
they're pushing the ones that cost more? Is that why?
Well, they just, they begin to not believe the true Vanguard mission, which was right. They like you said, they try to make it a little more complicated than this, and
That's what happens when you get too big.
Yeah.
Specs, so. Thank you.
Thank you all.
So much. Thanks, sir.
Any questions, just let us know.
Thank you.
All right, have a good night.
Yeah, thank you. Thanks for
Thanks for improvising.
coming in. Corey.
See you guys.
See where you have the winners in and out.
Good to see you. See you guys.
Rip it open, tell us who wins the Oscar.
Thank you.
I gotta find my envelope.
You had any more?
I know. But good thing Carol emailed it to you, right? Emailed you the spreadsheet? Okay, and when we had it, there were still 2 people that didn't see it.
Sure thing.
I thought we were just talking about it.
Sorry.
We're submit yours.
All right, so-
I can tell you what mine are.
So we all understand exactly what we're doing tonight. 'Cause I think we were all confused. We're picking 3 for
To
Lori
interview.
and Al and the working group to interview next month.
Okay.
And they're gonna ask those 3 questions, and then they'll come up with a recommendation of the one they think is best. And then at that point, we will decide, do we want to take the next step, which is the schematic drawing, that's the 100 to 125,000 cost. And I think we all agree that's a hard stop after that regardless. Now, we may not even take that step. Yes, after our sobering talk tonight, but you know, we have to discuss, and we probably want to do this in executive session. You know, do we want to float more debt and attempt this, or do we want to stop now and hold for a while? That's, you know,
It
that's
looks
something we have
like
to talk
from the thing.
But we're not.
It's like, unless we raise. No votes. Yeah, we're not gonna be able to afford it.
Hey, Richard, real quick, on the pension thing, a chart, because due to get a letter, right? We can do a chart, because I know Glenn likes charts. Can we chart 6.75, 7, 7.25, 7.5 on that, the reduction for 5 years, because
VN.
the end did a 5 years, so what is each one of them for 5 years, what's the savings? Or what's our cost over 5 years for the MMO?
Are you talking about just the police line or all the plans?
All the plans,
Okay.
but break it out, it's mostly the police, but break it out, so 6, 7, 5, 7, 7.25, 7.5, 5 years. So we know exactly, and then
Which path?
we could
to
just look at that.
Should I tell you my picture? I didn't turn it in.
And at this point, everybody's done their picks. It doesn't matter. I mean,
Well,
I
they
was,
don't
I
have
was just telling
police
them now,
choice.
just to be clear what we're doing here tonight. We all had a chance to look at the 8 packets and turn in a vote sheet. We're gonna announce who the top 3 were based on those votes. And then you and Laurie and the working group will interview those 3 architects, ask them questions about their proposals. And then at that point, we decide, do we want to go the next step, which is the schematic drawing, and that's going to cost us between 100 and 125,000 to do that. And then that's a hard stop until, we get further into the year, we finish this PFM study. And then we'll have to have an executive session, I think, to talk about what our financial options are to do this project. And at that point, we have to decide, do we want to go forward or do we not? Do we want to wait a year? Do we want to shelve it, whatever. But
I think in the very least with this, it gives you part of the whole PFM project is getting a capital plan. What you're wanting to do, and then it's trying to get a 5-year capital plan. So I mean, you probably, if you want to do a project like this, you need to know what it costs and you need to
Right.
plan for it.
so we need to know exactly what we're going to do. I mean, go ahead.
No,
And
I
not-
was just
not
gonna
just
say,
build it, but
whoever's tallying the votes needs Colleen's input.
You have your sheet there?
But I have a lot of scribbling on it. Yeah,
Well, I'd like ones.
I have now. I'll do 1 and 2. I liked KCBA. I like GCO. I had that question.
And 8 is the top ranking, not the low rank.
And
It's
I apologize, and you probably got back, today was a busy day again, sir, and I asked about those extra fees. Can you reiterate?
Yeah,
what those
so
were?
what I did on the spreadsheet, just so try and gather these things, I looked at who they had as consultants and I looked at their fees. So I gathered up all the consultant information. I think that was pretty straightforward. There were a few questions that I tried to answer, anticipating questions. But on the fee, I went to their fee section and I just listed what they had identified. So for the Gensler one, yeah, they identified a base fee of 660,000, I believe it was. And then they had enhanced services. And in the email, I did copy that section of the page from their proposal. But the enhanced services listed things like interior and exterior lighting design, energy modeling, managing the furniture layout and things like that for you. So other firms didn't list it as an enhanced fee or an enhanced service. So I didn't identify it as an enhanced service for any of the other firms.
Do you think we're still getting that service in the other firms, even if they didn't list them out? I guess to me, I'd want to know.
Yeah, that's the question. Right.
So
I think you're getting the questions, and I relate it back to the firehouse. GKO is providing interior lighting design. That's part of their service. I don't think we necessarily did energy modeling on the firehouse, but I mean, if Gensler is one of the firms you choose to, if that's nominated to be one of the firms you interview, that's a fair question to ask them.
So they're suggesting something to do something that we don't necessarily, may not need. I mean,
we may not need, and if it's not listed in the other firms, are we assuming they're doing it or they're not doing it?
they like furniture modeling or something, is that one line? Like,
Not furniture modeling.
Well, where the
Let me
furniture-
find their-
But for example, interior, exterior lighting design, if that's something, if you want the building to really pop and you want somebody to spend a whole lot of extra time designing downlighting or uplight or whatever somebody thinks might look really nice. If you want that specialty baked into the price, then You know, maybe it's better if you choose someone who is say, hey, I'm gonna hire consultants that specialize in, one of them was food service or something, food and beverage service. If you say, no, I accept that architect X will have a designer that will provide for appropriate interior, exterior lighting, whatever that specialty happens to be. Then you don't need to bring in a specialized architectural firm or consultant that
Like,
would do that.
Like they had, under the, enhanced services, acoustic design. Well,
Some of them had that.
that was my point.
Right.
Yeah.
And it's not that they had it, but that they didn't identify it as an extra cost. Audio visual design, IT telecommunications, structured cable. I'm not exactly sure what that one is, but
But it almost sounds like we need it. Like, if we don't do
Exactly.
enhanced services, if you don't get that, I take it no.
correct.
Like the acoustics, I think that's a big deal,
Yeah,
Whoa.
I mean, it's kind of like,
right?
why do we have to pay
Well, this
extra for it?
sheet-
Right.
This sheet, this is the one I'm looking at, you did.
Right.
So didn't you try to level it here on line 8, the fee?
And that's what I was doing.
Yeah.
I went through all the proposals and I took the extra fees that they identified that aren't in their basic service and added that number in. Some of them had, I think Breslin had no additional fees. For the most part, I think 3 or 4 of them listed reimbursables as an additional fee, and that was it. One of the firms had landscape architecture as part of their basic fee. Well, the discussions with Gilmore was if they're brought on, they would be doing landscape design. So that was money that you could take out of the architect's contract. So I was just trying to present where all the numbers are.
Apples to
and
apples,
just
right?
apples to apples, they may be different brands of apples, but at least they're all
So
apples.
we at least like 3, we interviewed 3, and then we can talk like, can we go to company B who had, this was the cost, and we can, if we pick them, they can reconsider their number, or we can't, they can't. do that.
This isn't a sealed bid, it's professional. You can
It's
negotiate.
professional service. Short answer is yes, you can do that.
Okay.
Long answer is, I don't like recommending that. We're also professional service,
Okay.
so.
She brings a big bag every. She'll bring a horse, she'll ride it like a cowboy. Feed them up on the number.
I've got the whips and the chains out, but I probably don't have the horses.
Yeah.
So basically what we were looking for was a
We're not on
scorecard.
Zoom anymore, are we?
Yes, we are.
We are still in the air.
There's a thing called redaction software.
So we were looking for a scorecard from each individual supervisor. And then we would take your positions and with the one you thought best represented what you wanted in the library gets 8 points down to 1. And the 3 firms that come up with the highest score are the 3 that you interview. Now, my only recommendation is if 3 and 4 tie, I would recommend you interview 4 firms.
I had a hard time picking 3, I liked 4, so.
I wouldn't recommend a 3 and 4 tie, eliminating 1, just to keep it at 3.
Right, yeah.
Oh, what we got?
I like the first 4.
Crunch the numbers.
I think, isn't that what you're doing?
Well, let me do this.
Oh, I thought you were. Okay.
John, did you just get a dart and just throw it at the thing?
I didn't pick. I'm the guy that didn't send one in.
Okay.
Well, let me give you blanks.
Why is that?
It's okay. I'm not, I feel like I'm being drugged down this path, but I don't want to go down, so.
If your selection is none of the above, that's fair.
Say that again.
If your selection is none of the above, that's
None of the above,
that's fair. So just if you want to list them 8 to 1.
Oh,
Okay, we just want to give them points.
And
The one
Elaine-
you like the best is 8.
Yeah,
You're-
only an A being your top choice, not your bottom choice, because it can be,
It's
it can be,
876.
it can be
Eight is your top.
counterintuitive.
I like and sort of like the fact that they cost. so much.
8765 and everybody else.
Do not pick this one.
They did the
How about this last one by
Right.
Ted?
What was that?
What do you say?
Other than that, I got no.
And the other one was okay.
So if
this is go with the-
That's, it's supposed to say out now.
I know, but some of those.
The other one
enhanced things
I can say.
USA was was close, but something, you know, the USA, the name killed me. Stop, think about her name. No, just there was. USA, where are they from? Were they from
USA.
Fox County?
Easton.
They weren't too far away.
They're Easton. Nah, it just was.
They were the
too
runner-up
plain
in the
enough.
firehouse.
The one with the biggest presentation was the most blocked. That,
Philip and
yeah,
Donovan.
yeah, I got
Yeah,
tired
that
of
was
reading
big,
about 2
yeah.
pages in, like.
I kind of like recent sign.
They did the
Except for
firehouse.
that's what I
Do you
like.
know- Then I work back.
So I want design.
Yeah, it gave us some
okay,
ideas, and if
Yeah,
you're
it gave
gonna
you some
bother
ideas.
giving us some ideas.
Absolutely.
Work on this present was a big
I
one, and
agree.
they didn't really give you ideas, it shows your blueprint. Present. They didn't show you any kind of.
No, they didn't
Creative,
They didn't.
that's
They
why I was
showed
like,
you a
okay, your
footprint.
top firm, we did, what, 100 libraries, but they
They paint
didn't
me a
show you
picture.
any creative.
Yeah.
Well, I mean, I think they still should.
Yeah, and then when you turn the page on that one that did the Kimmel, well, I like them because they did that Haverford place that we saw, which was nice.
Right, but.
And then when I turned the page on.
Yeah, yeah.
Wait, is this a typo?
Yeah, Al, I kind of did the same thing. It was like, wait, what?
And then they pushed it out there like it was a great place.
This is dark, maybe. Dark.
I'll tell you what, though, the report was sobering.
Yeah.
Thorough.
There's no extra money laying around. I was looking.
No.
Couldn't find it.
You kept asking, I appreciate
I
that.
was looking all the time.
You're gonna go
All
for
the
the couch cushions now, Bill?
John, you brought up a good point though on the reval. The county, I mean, we are getting, the fact that the county hasn't done a revaluation
Yeah.
for 20 years, we're
losing.
especially when you've gone through the type of
Everybody
growth.
is.
that we have.
So is there any process in place that we can request that they?
You
do a
need to
reassessment?
engage, you need to speak to your commission.
You're balancing.
I will tell you historically, a reval at the county level has always been historically very politically unpopular.
And then they got pick the company that's doing everyone's tax, right?
No, I watched their taxes.
Like if you're
Oh,
in, you
yeah.
put it through,
Oh,
people are
yeah.
gonna kick you out.
Then they'll fight over the millions of dollars for the company that goes by with the TV, with the cameras on the car, oh, well, we verify, that's a fight. Who do you know? You got the contract.
I mean, just the fact that they haven't reevaluated
Yes.
or reassessed
Yeah.
is
Hold on.
almost as bad as California capping it at 1973 values.
But I
Let's
do
go buy
think
a house
it's,
there.
but I do think it's reasonable that when a property sells, to do a reassessment.
Yeah, that's
adjustment
true,
and
Bill.
keep the assessed value low.
Those bills have been introduced at
And
Harrisburg and they
It's
haven't gone.
insane. that-
Well, I'm not gonna do this again, so I'll be the go. I'll be the guy that takes it to the county and says, we need to have you do this.
You're
Now,
not gonna do it.
before I
We
do it,
can always ask.
tell you what the numbers are. Tim had mentioned one of the questions that you were asking about, was pricing. The lead time and pricing of some things right now are just ridiculous. The price, I got a 5-gallon can of gas and a sheet of plywood in my crotch. I'm rich.
Yeah.
The experts are predicting that will level off. Probably more towards the beginning of 22. The numbers are going to start coming down through 21, but they said it's going to should level off in 22. Not exactly where it was pre-pandemic, but back down to those levels. The big thing is the supply chain. People not wanting to go back to work, or people choosing different careers. So that's really where the bottleneck is.
It's steel, plywood, and concrete, and what's driving everything. Should level off.
So you think it wouldn't hurt us to slow down on this?
Well, the schedule that we had laid out to consider was to go through 3 months of schematic, keep the architect on board through the fundraising phase, to have them help with renderings, modeling, anything that you need for marketing purposes to go out and raise funds. And sign their contract at that point. And don't go beyond that. And that fundraising phase was about a 6-month process. At the end of 6 months, start them up again and do the design, development, and construction document phases. That there would probably take about another 6 months, and then bidding, and that kind of puts you right at 22, 2022, where things should be back to quote unquote normal. Now that's pricing. I have no prediction on where interest rates are going to go. I mean, right now, money's practically free to borrow. So
Borrow and don't now. And wait until prices drop.
Well, when you borrow, you have
free.
the clock
3
stops, have 3 years to use.
So I mean, that's beyond my expertise. That's these guys. I can tell you that, most of what we do is public bid work, municipalities, school districts, things like that. And last couple of projects, we got some decent numbers in. So contractors are being aggressive with their pricing. So that's a good sign too. So you want me to read all the scores or just tell you who the top 3 are?
Can you tell us who the top 4 are?
Top 4 are Gensler has 30 points. KCBA has 25 points. GKO has 24 points. And then Phillips and Donovan has 17.
They're the big book.
That's the big book where they didn't get any ideas.
That's pretty convincing.
No ideas.
No ideas.
What's that?
30 out of 32, that's pretty
I
convincing.
thought
So
there
it's
was a
3.
ton of ideas in their book. What are you talking about? I
They
like
they
Fell
both,
asleep 6 times.
Okay.
no, they gave us no ideas of what's going on.
So the nice thing with the proposals are, it's basically a design competition. You interview 3 architects. If with Gensler being the top vote getter, I mean, asking them about their enhanced fees is fair game, fair questions. And asking GKO and KCBA, is this included in your base fee? It's a fair question.
Just so we know.
Yeah.
Level playing field.
So this means the first, next Monday at 1 o'clock, right?
15th.
Tuesday. Tuesday, yes, correct.
One to-
Tuesday,
one
1
to
o'clock.
4.
Perfect.
What are the,
What,
can you
you're
tell me what the
interviewing
top 4 are?
Yes. Gensler, GKO, and KCBA in alphabetical order, and we interview them in alphabetical order. So then we'll pay those.
I'm sorry, what was that? It's Tuesday at when?
1.
1 to 5, we'll be, guys will be in here.
And then at that meeting, what are they presenting? Their books that they're just going over their proposals?
They're
exactly
gonna,
what it is?
we're gonna give them 25 minutes to present. And then we're gonna say we get 20 minutes to ask questions, so that's a 45-minute window. 15 minutes for them to shut down and get out, for the next one to get in, so they start.
So it's an afternoon.
Are they in person?
Yes.
Yeah, some questions I'd like you guys to ask are, how much flexibility is there in your plan? Anything we can do to save a little money? One of them, I don't remember which one now, but one of them had a very chopped up floor plan. And I felt like even though they talked about open space, it looked to me like they had all these little rooms and walls in there. And I feel like I want a little more open so that we can configure things as we need to going forward.
Yeah, an open, I like the.
Yeah.
The other thing to remember is all these were put together with none of them actually talking to you. We took all the information that LSS put together, that we put together, the budgets, the timelines, as much input as we could get from the township and you, and said, here, tell us what you think. So,
Yeah.
and if there's something in one of the other designs that you really like.
Yeah, yes. So, yeah, I mean, that's a great point. So if there's something in the design you like. put that in there.
Should we think about that before the meeting or after? You pick the one.
I think,
Pick the one.
I think we should know. what
If,
we
if,
write.
since it's Al and me and whoever else is on the committee, if you guys would send us the questions that you want us to ask.
I'll put together a list of recommended questions too. I think something that's gonna be important is what they bring to the table during your fundraising phase.
I'm sorry, who were the top three again?
Gensler, GKO, and KCBA.
Okay.
So what do you mean by
So
that?
how
How
can
are
I
they
get
gonna
my
help us
comparison?
fundraise? What are the assets they're gonna give us?
Well, we already have a fund.
I mean, what are their capabilities
Schultz
with
and Williams.
3D model? What are their capabilities with fly-throughs? And I can help with some of those questions next Tuesday.
That's a good.
Do they offer any kind of virtual reality that you could use? If you're going to Merck, can they put Merck in the model and kind of show, what you're thinking?
Have they ever gone with township? The admin or I guess supervisors for a committee we set up to go speak to somebody like a Merck?
We told them that part of their duties during the fundraising is be available for meetings as you guys see fit. If it means taking them along to explain a design concept, they're the experts
I
on
think
it.
if
Let them
it's a
talk.
big enough person, I think we should have all the
Yeah,
big guns out.
Depending on how many zeros are behind that number. Absolutely.
Don't you think that we wanna,
We want them at your disposal during that phase, so you can gain as much as you can with their help.
I just want to say about open space, it always looks wonderful, and I know libraries are supposed to be quiet, and we should have acoustical thing that closes it down, but I was in a grade school in California that was open design. I walked in, I left in less than 5 minutes, because I knew it was going to drive my kid nuts. Now, that's an elementary school, it's a totally different environment, but I start to worry when somebody says, open design.
One of the things we told them at the pre-proposal meeting where we had all 8, you had 9 architects at the time. We said, the attention to special needs, no matter what that special need is important. And we don't want a space that's closed off in a corner. We want them to have the quiet space and have the visual parts that they need so they can function, but it needs to feel like it's part of the overall building.
Hey, guys, this is Debbie.
I got
Hey, Debbie.
You scared everybody.
Oh, I'm kind of I'm piping up after 2 hours in. I just wanted to mention, Lori, that when we think about designing library services, I think we talked about sensory inclusivity. So that is a very specific type of designing library, not just spaces, but also services, and those two things go together. So the library in Upper Providence is gonna be sensory inclusive. So as important as that is in the architectural design part, I guess I'm saying not to worry too much because this whole very specific process will be in place. Does that make sense?
Yes, thank you, Debbie.
Okay, I will scare you no more.
We invited Debbie to the interviews as well.
Yeah.
LSS is your library consultant. We want them to be part of this discussion as well.
What do you think of the choices, Debbie?
I concur with you guys 100%.
Right answer.
Yeah, those were my favorites.
Download by 15 tracks.
Did not see that one coming.
Debbie, since you're there, is Todd there? Just say hi to both of you.
Todd is not on the line tonight.
Okay.
I think he's on the road.
Okay.
Thank you for sitting
Very
through
good.
those 2 hours of everything so you got to say goodbye. Scare us all to death.
Been super interesting.
So what I'll do tomorrow, Tim, is I'll send a letter out to the 3 firms indicating that they've been selected for an interview, 1 o'clock, 2 o'clock, 3 o'clock, alphabetical order. And I'll send a letter out to the other firms saying, thank you for the proposal that you were selected.
Okay.
And then we'll go from there.
Very good.
All right.
Very good. Sounds good.